Welcome back to another episode of Loanology. I'm your host, Jonathan Wells, and we are going to talk today about tax benefits of owning your own home. Hello, and welcome to Loanology, your go-to podcast for unlocking the secrets of the mortgage and real estate world. I'm Jonathan Wells, and I'm here to guide you through everything from first-time homebuyer grants to the latest trends in real estate. Whether you're buying your first home, looking to refinance, or simply interested in the market, you're in the right place. Each week, we'll dive deep into topics that matter to you, the consumer. We'll demystify the mortgage process, explore innovative financial solutions, and provide you with the tools and knowledge you need to navigate the real estate market confidently. From interviews with industry experts to tips on improving your credit score and securing the best mortgage rates, Loanology is your ultimate resource for all things mortgage and real estate. So, whether you're here to learn a few tips, find your next home, or just curious about the market, tune in and let's make your real estate journey a successful one. Today, we're going to dive into owning your own home, how it can not only be a resource of comfort and security, but also a significant financial advantage when it comes to your taxes. So many people don't realize how beneficial homeownership is or it can be around tax season. So whether you're a first-time home buyer or you've been owning homes for many years, understanding these benefits can also help make a difference in your financial planning. The first one that we're going to talk about today is the mortgage interest deduction. So a lot of these are going to come into play if you are itemizing your taxes. Not all of them require you to itemize your taxes. However, most of them will. So if you are taking the standard deduction, then this may not apply to you. There are still some benefits though to look out for towards the end. But first one being mortgage interest. So you can actually deduct the mortgage interest that you pay from your taxable income if you do itemize. So it can obviously be especially impactful in the early years of the mortgage when interest payments are at their highest. And how it works is if you're itemizing your deductions, you can deduct the interest up to $750,000 of mortgage debt. This cap applied if you took out your mortgage post December 15th, 2017. Older loans have a higher limit of $1 million. So for anyone that's out there shopping right now, your cap is $750,000 of mortgage debt. However, most people probably aren't taking out that much in mortgage debt that are watching this podcast. So, it's definitely going to apply to you. Second thing, let's talk about property taxes. You can also deduct the property taxes you pay on your primary residence as part of your itemized deductions. The total deduction for state and local taxes, including property taxes, is capped at $10,000 a year, or $5,000 if you're married and filing separately. So if you're single or married filing separately, it's $5,000. If you're filing jointly, it is $10,000. While this cap can limit the deduction's impact, particularly in high tax areas, it still offers a significant savings for many homeowners. So yeah, it depends on the value of your home, and then obviously the taxes that you're paying as part of that value. So for Indiana, like my home right now is worth between $500,000 and $600,000, but my tax bill is like $3,500 because I live in an unincorporated area, and the assessed value hasn't really caught up to the appraised value yet. So that would still work for me because I can write off my whole tax bill because I'm going to write off $5,000 or less. Whereas somebody who may live in Illinois and they're paying $12,000 to $15,000 a year for their taxes, if they're in the similar position, they're not married, and so they're filing single, that may you may not get as much of a tax break, but you'll still get a tax break, right? Section 3. Home office deduction. So this is super important if you're self-employed or if you want to start a side business. So with more people working from home than ever, a home office deduction has become increasingly relevant. If you use part of your home regularly and exclusively for business purposes, you may be able to claim this deduction. This can include a percentage of your mortgage interest, property taxes, insurance, utilities, and repairs, all proportioned to the size of your home office. So I believe this is for only for self-employed people. Don't quote me on that. But yeah, definitely something to look into if you have a side hustle or if you are self-employed. Definitely look into the home office deduction for sure. It's going to help you save a lot of money. Attention financial planners, Jonathan Wells here with the John Wells Group powered by Leader One Financial, and I'm here to collaborate with you. Whether your clients are purchasing a new home or refinancing for a debt consolidation in Indiana, Illinois, Michigan, Tennessee, or Florida, I'm providing expert mortgage solutions tailored to their financial strategies. Book a virtual meeting with me to explore how we can optimize their financial plans. Schedule now at the link below, and let's build stronger financial futures together. Energy efficient upgrades. So if you're making your home more environmentally friendly, the IRS offers specific credits for that too. These include credits for solar, electric, solar water heating equipment. Throughout 2023, or through the year 2023, you can claim 26% of the cost of these systems, including installation, with no upper limit. This percentage steps down to 22% in 2023 and is scheduled to expire in 2024 unless extended by Congress. So look into that a little bit if you want to add solar, heating for your water or solar for electricity. Definitely look into these options too, and check with your accountant as well, because you could potentially save, anywhere from 26 to 22% of the cost of those systems, installation and everything, to help with your taxes. So lastly, let's touch on the biggest potential tax benefit, which this will apply to anybody who owns a primary residence, regardless of your employment type, regardless of your tax status, regardless of anything. This is the number one reason why owning a home is one of the best investments you can make, which is the exclusion of capital gains when you sell your property. So if you've lived in or owned your home as your primary residence for at least 2 of the last 5 years, before selling, you can exclude up to $250,000 of your gain from your income if you're single, or up to $500,000 if you're married filing jointly. This means the profit you make from selling your home may be tax-free to these limits. So, for example, what this means is if you're selling an asset, typically you're going to have to pay capital gains on it if it's gone up in value. So let's say you purchase your home for $250,000 and you sell it a couple years later and you sell it for $300,000. Well, you technically made $50,000 off of your home, right? You may actually net more than that because you have, you paid off, you had a down payment when you purchased your home, you've paid, your mortgage, or you paid cash for the home or whatever. So you'll make more than the 50 grand at closing, but 50,000 is the profit you're making from what you sold it, sold it above what you purchased it for. So if you're single, you can sell a home and make a profit of up to $250,000 tax-free. If it's over that, anything above that would be added to your income. So let's say your taxable income for that year is $100,000. You sold your home and you made a profit. So you got $300,000 more than what you paid for it when you first got it, and you're filing single. You would add $50,000 to your taxable income. So you'd be paying taxes on $150,000 of personal income for that year. However, most people aren't going to see a realized gain of, more than the 250 to 500,000 unless you're buying in a high-end luxury market, right? So for most people, like I bought my first place, paid about $173 for it, and sold it 2 years later. So I was just covered by this rule. Sold it 2 years later for $230,000. So doing the math, I basically made $57,000 off of it. Paid some money for realtor fees and closing costs and everything else, and I walked away with quite a decent amount of cash, from that purchase, and all that money was tax free. So this is definitely the number one way to increase cash net worth is when you're purchasing homes and you sell them every couple of years. You're able to pull out that money and you're able to make it tax free. So I love that. That is definitely one of the best ways or reasons to invest in real estate, because any other investment that you make, you're going to most likely pay taxes on unless you're taking it out in retirement, right? So there you have it. Some key benefits come from owning your primary home. As you can see, the financial perks extend beyond the surface, providing substantial savings that can help you drive your real estate decisions. Always consult with a tax professional to fully understand how these benefits apply to your specific situation and to get the most out of your home investment. So thank you for tuning in to Loanology. If you enjoyed this episode and found it informative, please don't forget to subscribe, share, leave us a review wherever your podcasts are and wherever you digest your content. Stay knowledgeable, and I'll see you next time where we decode more secrets on the mortgage world. Cheers.